Good afternoon, good evening, everyone. Welcome to the March meeting of the International Model Investment Club. Pardon me, tonight's, we're going to go through the introduction disclaimer as well as the agenda, and we'll begin tonight's meeting. My name is Mina McHale. I'm the current chapter president and your MC for the evening. Quick disclaimer, our International Model Investment Club is open to the public and was founded in May of 2016. All our meetings are held online and virtually, and thus allow us to have membership from around the world. Our meetings are held on the third Mondays of each month, with the exception of December, when we meet on the second Monday of the month. In this club, we use hypothetical money, so to avoid all sorts of currency issues, taxation, and all the logistics of actual investment. And it allows us to, again, open our membership internationally and to take bold decisions for learning. As we go into this club's primary objective is to be used as a learning lab, or to allow us to apply better investing principles and the fundamentals of stock investment to real world companies, and to allow us to actually engage in the application of stock selection guide and annual reviews. We currently have 12 members from across the United States, Canada, and China. You'll see there's a control panel on your right-hand side of the meeting. The agenda is available on the drop-down menu under the handout section. All our guests and visitors, welcome. You will be muted for the duration of the meeting. However, please feel free to post any questions in the questions drop-down menu in the same control panel, and we will do our best to answer them in real time. At the end of the presentation, you'll be unmuted and be provided an opportunity to ask questions, provide feedback, and engage in some discussion with the club. All our sections are timed now in order for us to respect your time as well as the times of the presenters. So we're going to be timing the segments, and you may hear alerts to members advising them of kind of coming up on those limits. As a disclaimer, the information that is presented today is for educational purposes only and is not intended as a recommendation to buy or sell any of the securities that are mentioned. The views expressed tonight are those of the participants only and do not necessarily represent those of BetterInvesting. The investors and guests should conduct their own research and analysis before making any sort of investment decisions. The securities discussed tonight may be held by the presenters in their own portfolios. These presentations may contain images, websites, products, services, research tools that are not necessarily endorsed by BetterInvesting or by the presenters themselves. And finally, these meetings will be recorded and will be posted to our YouTube channel for future reference, and there you can find past meetings for your enjoyment. So at this point, we'll just make a quick review of tonight's agenda. Reddy will present our treasury report to give us a summary of our current portfolio and the state of it. We'll then receive an online chapter review as the education topic from Joanne. We'll then have, tonight we have several annual reports that are due, so we'll go through those and review the companies as well as have any discussion. Then we'll open the mics for guest questions and feedbacks, and then we'll move on to club business. So at this time, I will ask our treasurer Reddy to take over the screen and present our treasurer's report. Reddy, it seems that you're self-muted.
Okay, sorry about that. I will present this month's treasury report. For last few months, I have been depositing the membership money just prior to the meeting. Like yesterday, I deposited 14 members $1,400, so that during the club, we can make decisions to update money and make decisions on buying new stocks. Last month we did not buy anything, we did not sell anything, and no payouts. As of today, the cash balance with the new deposits is almost 6,000. We can consider buying something with that based on the club's discussion. This is our heat map. Heat map still shows VRTX is the largest block. All others are proportionally not bad. Nothing small, nothing big. They're all average sizes. The losses this month, we did not do good because of the whole equity market. We have more losers this week, this month, and I listed here the major losers around 1,000 or above. I listed, not the small losses. I did not list them. The Schwab and VRTX are still the best gainers, and including Amazon, Algonquin Power, Alphabet, LGI Homes, and First American. We have losses. I'm interested in hearing LGI presentation today. I own a few of those, but still all the real estate stuff is going down. Next one is this shows the detailed all our portfolio with the gain and loss. You can see how many of them, majority are in the red. Next slide is our club performance. We are slowly improving compared to last year. Last year was the major setback. The club performance is way down. With the past 2 months record, we are slowly improving that. But this month again, kind of everything is down. Now here is our portfolio review chart. You can see more pinks and more yellows, which means all those are not doing good or negative numbers. That's not because of partly not because of our stocks, but because of the market conditions. Our club assets are shown here. We have fairly good diversified and nothing small and nothing huge, big, unproportionately big. The diversification wise, we have all these small, mid, and mega and large caps. We can consider investing this cash in, shown in blue, almost about 10%. The diversification among various industries or various sectors, we have still probably for a few months we are representing about 8 sectors here, and 3 are still missing. We do not have anything in consumer discretionary, energy, or industrials, but we have all other 8 sectors. The last slide is diversification. These are various industries in the sectors. We have good diversification of the industries. Any questions? Hello?
Already. Oh, I do have a question. Can you go back to the everybody's SSG with the pinks and the yellows? Yep, you just passed it. That one. Okay, everybody, do you notice where the price is with the red numbers? That means you have not updated your SSG. So these are based on old prices from, I guess some of them are from 11/22. Megumi hasn't updated her since February 22. So we need to make sure that we update our SSGs. And I can go over again how to do this for my iClub, but this is necessary for our portfolio review.
Joanne, do you mean link them or update them? Because like
Well,
mine is updated,
okay.
but I don't. Do you have to link it each time you update it?
Okay, so I have one. Let me talk. Ready? Let me talk. So I have one SSG called My iClub. I update, if I want to save off a copy that has a date on it, I save it off, but I only, the SSG that I have linked to My iClub is called, I forget what mine is, Schwab My iClub. So every time I update that, it automatically shows up here and you don't have to relink.
I see. Okay.
Okay.
So it's the one that's you just make sure it's the same one. Okay,
Yeah.
got it. Yeah.
Okay. Can I say my comment?
Yes.
Annie used to do a very nice job and reminding everybody a couple times before the meeting. He called it gentle reminders. You have to not only update the SSG, but if you change the file name, you have to link it also with your latest file name.
Correct.
Right. Okay.
Okay. So if you did not change the file name, that's fine. It picks up. But if you change the file name to update and a new date or new name, you have to link that new name.
Okay. So if anybody needs help on that, just ping me and I can help you. Okay. Okay, are we ready for the next My section? John, are you there?
Yeah, absolutely, Joanne. I think we're ready for you.
Did somebody give me the presentation?
Yep, let me pass it on to you. Oh, I don't know. There it is.
Okay. All right. Is everybody aware that we are part of the online chapter? So what an online chapter is it serves any member or club that does not have a local chapter. So since we're an international club, we don't have a local chapter that like over us. So we belong to the online chapter. And does everybody get the newsletter, the online chapter newsletter? Is there anybody that doesn't get the online chapter newsletter?
I don't get it.
Sorry?
I don't get it.
Okay, you don't get it. Okay, so.
I don't get it either.
Okay, I will make sure that everybody in our club gets the, it should come out every third Wednesday, I believe. So, and what it does is it lists education topics that are coming up. It lists other model club meetings. It lists, like recently we had a portfolio contest that next year I think that our club should participate in. It's where you, and it's not really a long-term strategy because it's only for, I don't know, Jay, how many months is it? Like 9 months? But you compete against other teams on stock selection. So that would be interesting, I think, for us. And then, so it lists other things too, like the, let's see, education topics, and then there's satellites. So there's, which I believe Isla belongs to, but Isla's not in this meeting. She has another club that doesn't have a local chapter that they refer to as a satellite. So this is so how you come to this page is you go to betterinvesting.org/online, and then it'll redirect you to this chapter/online, but all you need to do is put online after the betterinvesting.org, and it'll take you to our homepage. And this is our homepage, and it'll list the local events here. So here we are with our clubs. so people can register to come to our meetings here. They can also go to Yankee, and then there's South Texas. And then here's our an online chapter mentoring workshop. The next one's in May, and it's actually an open forum. So if you have questions, you can ask the speakers. It's very informative. It's only an hour, and it's 8:30, 9:30 Eastern time. So, and then we have our contact section, and you'll notice Jay and I are part of the online chapter. They're calling it a president's committee because nobody wanted to just be the president themselves. So we have Suzanne, myself, Jay, and Chris that are kind of overseeing the chapter right now. Let's see. There's also this program called Visit a Club. So for investment clubs, and we already had Avi come to our club and give us a presentation, but we also might want to find, we should take advantage of the opportunity to have some of the more senior or experienced BI leaders come and visit our club and give us some tips and how we can improve. Also, okay, so here's another area is so we've recorded all of our mentoring workshops, and there's slides and video that go along with it. And then here's the portfolio contest I was referring to. I think there's some kind of award that goes with it, but I think it's nominal. I think the point is to, engage with other members and just have this imaginary, well, we already have the imaginary fund. Okay, and then here's our monthly newsletters. I know you may have missed them, but let me just show you the latest. So this is the newsletter that went out. We actually have board meetings once a month, and all of our members, you also are included as a member. You can register to go to the board meeting. And then this is the, we just had the March program, investing in ETFs. And then there's the update on the portfolio contest. These are the all the different people and clubs that participated, how much they invested, and how well their portfolio is performing. And then, so we have other membership coordinators. So they offer a lot of support, and if you want to form a new club and club accounting. So let's see. And then here's our club right here, International Model Stock Investing Club, where they can participate, or people can register for our meeting. So this comes out once a month, gives a brief summary of what's going on with our online chapter. Oops, what did I do? How do I close this? Back. Okay. So this is a good reference point for people if they need articles of interest. We're going to be adding more educational webinars. We're going to try to create or curate all the different recordings and presentations that are out there, so and rate them so that people don't have to keep digging around to find good presentations. Let's see, we're not part of a satellite. These are all the current satellites. I think Isla is in what, New York?
New York.
Is she New York City? Yeah. Okay. Anything else to add, Jay? Jay's also part of. Oh, volunteers. Yes. So Jay and I both started out as volunteers, and there's a lot to, if you're interested in learning about newsletters or updating websites, or there's membership volunteers that actually go and coordinate with other clubs. It's a good way to support the BI community and to learn more about what's going on with our BI organization. Do you have anything to add, Jay?
That's all.
Yeah.
Oh yeah, I want to say the visit club in here is visit a club different as a somebody visiting a club. Visit a dash a that club, meaning that you are welcome to you are welcome to invite other people to be your club, which I believe we are on the list as a visit a club.
Oh,
Meaning
okay.
that if you're looking for a club near you or any other online, whatever clubs that you're interested, you want to see who's available near you so you can visit. That's
Okay.
what that is. There's
Oh,
another portion of that you just mentioned it, but that they did not advertise here.
what?
The visit a club, like they have volunteers to come,
Yeah.
like Avi just did. We can invite Avi or whoever we want from BI to supporting us.
Yeah.
Yeah.
Okay. Are there any questions?
We need the volunteers.
Yeah, we're well, we want good volunteers because we have a lot of volunteers right now and they don't do anything. So
They don't do anything. And then, sorry, you will get incentive. They don't do anything, so we probably have to roll them off because it's not fair. For it costs BI, right? Because you get incentives on your
what is
membership.
what is the incentive? I forgot, Jay.
I think you get free tools. You only pay membership, but you don't pay tool.
Oh, okay. And then don't you get like a subscription to something or?
Yes, there are also other. Once you become director, I think you even get discount on better investing national convention or something.
Oh yeah. That's
Yes,
true.
you also get description from what was the one that Scott was IAS? I don't
Oh,
know if it just ended, but I have received the free ones.
advisory services, investment.
Yeah, newsletter.
Yeah.
Investment Advisory Services, IAS.
Yes.
Yes. Thank you, Eddie. Okay, so that's my little education piece for this meeting. So we move on to the annual reports.
Perfect.
Okay.
Since you have a clear recommendation, do you mind going first?
Yeah, sure. I can go first.
Let me just hand you the
So we get
screen.
shot down early. Okay, here we go. So I'm going to time myself for 12 minutes because we should have about 14 per person, it seems like, right? So I told myself for 11. And if there's any questions or comments, feel free to comment as well. But we're going to stick to the buy and sell stuff during the buy and sell time. I don't want to like debate buying and selling
Okay.
anytime beyond that. So it's Alphabet, or otherwise most of us know it as Google. These are the various things. Reddy, I'm sorry I did not give you time to review this. I apologize for that. I did it last minute. So yeah, you're gonna have to look at it now and review it later if you want to, and make recommendations later if you want to. But or as we view this. So we brought it at 133 in 2021 September, and right now it's 101.22. It's gone down some. There's the low and the high for the 52 weeks. Current P ratio is 22.21. So I consider that to be pretty low for a tech company, but tech is being hit really hard right now. So maybe it's pretty standard for a tech company right now. Average PE over the last 5 years is 24.3 and low 18.8 and 29.8 for average high. Revenue growth, I just able to check this out, and I was able to see that the revenue has gone a little bit up quarter over quarter, and 76 billion in this last quarter. Fiscal year, it's gone up decently, 9.7%, 282 billion, 220.8 billion, and it was 257 billion last year, last fiscal year, which is the calendar year. Total current assets has gone down somewhat, and liabilities have gone up somewhat. So the current ratio was an awesome 2.93 before, or maybe a little too high, honestly, 2.93. And now it's a very good 2.38, which is very good for current ratio. Free cash flow, I did the easy method, which may not be best for a tech company, which is just to see if I have I do not have it open right now. Great. Let me get that open then. I'm going to go to the free cash flow, the cash flow statement of cash flows, and show you what I did. I took, okay, here we go. I just took net cash provided by operating activities and subtracted the next line down, purchase of property and equipment. There's other ways to calculate free cash flow that might be better for tech companies, but I did the lazy method and got those figures that were there. They purchased less property and equipment, or whatever that counts for Google last year. This is 2021. 2022, they've been about the same amount of net cash provided by operating activities, purchase more stuff, so or whatever wherever Google purchases for that purpose. So it's a little bit lower. And we got the historical sales growth rate, 10-year 19.9, 21.1 for 5 years, a little bit better. Quarterly 22.5 and 9.8 trailing for a quarter. So it's still doing okay. I guess that's pretty much the year sales growth, doing pretty well still. As you can see from above, you can tell that from above. But I kept my SSG forecast the same for sales. This might be 11.7 now. I tried to update my report, like what Joanne was talking about, the one we use for Reddy's treasury report, and I just did the preferred procedure. We can manipulate that all we want to in a few moments here, but so 18.2, 25.8, this is negative, or the EPS has been negative and quarterly in the past trailing 4 quarters. It's gone down. So shares outstanding is pretty much the same, a little bit less, so they bought some share buybacks, which people love to see that. So pre-tax profit on sales is down, as we can see. I put it in red so we can tell that that's negative, but 25.2% pre-tax profit on sales is still pretty solid. Maybe not as great for a tech company where there's not as much cost of goods sold or cost of sales. But then again, return on equity is up and good. Debt to capital is up, which is bad, but it is 10.4%, which is nothing to worry about, in my opinion. I wouldn't care so much about this unless this was up in the 50s, the 40s, or the 30s, or the 60s. Then I might care so much, but 10% I don't really care. Never find this, honestly. Not sure who does, but next year guidance from the financial statement, they acquired this company, 6.1 billion. So it's kind of a drop in the bucket for Alphabet. I put buy. I'll show you my SSG, and then I want to show a report. I kind of been in my lazy theme. I use this. I really like this Seeking Alpha article that I found, but okay. So this is the one I had open that I'm not sure if this is the. I think this is the one that I just. Yeah, I'll close this. This is the one that I just changed the name because yeah, this is the one. Okay, so as you can see, let's just change this up for the 5-year. We already saw the 5-year. What the 5-year was my Word doc, but my Google doc, but 21.1, and then the 1 year, so to speak, if you want to call it that, is 9.8, and let's add these back in here. But okay, so there we go. I put 10 to be this is the trend line, but so I figured this is conservative. Chat GPT is associated with Microsoft and Bing, is good competition for Google, for Alphabet, but so they may struggle for a while they try to compete with Chat GPT, which we saw in a previous education topic, which is pretty cool. So 10% growth rate is what we're looking at there. A little bit higher than, I guess, the analysts. The analysts say 6.9%, 2-year estimate though, not a 5-year estimate, 2-year estimate. But EPS long-term estimate 15.3 is higher than preferred procedure. There's analyst estimate, there's preferred procedure, 11.7. So that's pretty much what that is for me. Now let's move on to valuation return. So I just picked pretty much the average PE, 24, a little bit low, below the average PE, 24. Now PEs will go down, as Handy might say. Perhaps it will go down below 24. So, but that's what I picked for now. We can change that if we want to. This is 20% essentially of the current price, or yeah, 20% down from the current price, 80% of the current price. maybe a little bit, I don't know, up or down. I don't know how that would actually turn out, but it's 102.46 right now according to this SSG. And so you could go like further down you go, the worse the upside downside ratio becomes. So if you want to say 78 or 75, or it will go to the hold zone. Right now it's in the buy. The way that this has been looked at right now. Now, before we open up to questions and comments and so forth, I got about 3.5 minutes left. I wanted to show this article. It's pretty cool. I like this guy. He kind of reminds me of, he is obviously kind of a value investing, or not a value investing, but a Buffett investing type person, which is how I got into studying investing in the first place. So he talks about, will recession harm Google? And I'll just skim over this, and you can read this article if you want to. It's in my folder. So he says decreased advertising spending perhaps might harm it, shifts in consumer behavior, increased price sensitivity, and a preference for value. Just need to adjust their advertising and marketing strategies come to these changes. Disruption. You have GPT could fit in here just because it's there, but you had format stricter regulation focused on privacy could hurt the company. But then recession might help the company because increased demand for cost-effective solutions. So they might use Google Workspace, Google Cloud Platform, which is relatively cheap, but Google just does so much volume and just crushes on volume, so that they can just get revenue, but and they have so much behind them to be able to afford to do that stuff. Increase search traffic, they may turn to the search engines, and this can increase search traffic and revenue for Google. Now, Google's financial health, which I covered a little bit, current ratio 2.38, which is what I saw as well, is very good. If you run, and that's if you know about the current ratio, you know that's quite solid. Quick ratio 2.22 is even better, right? Even though it's a lower number. A quick ratio of 2.22 is even better. That's I forget what the quick ratio exactly covers, but it's very much like cash. Pretty much very, very, very liquid instruments divided by liabilities. So current liabilities, excuse me, not all liabilities, but current liabilities. Operating cash flow to current liabilities to 1.32, which is also solid. So the financial health looks good. I don't know where you got this from. Debt to equity ratio of 0.1. Oh, that's where it is. Yeah, I meant this. Debt to capital ratio of 0.03. I don't know what that means honestly, but debt to equity ratio is 0.1 is, as I showed earlier, that's what it was, and it's not that bad as far as that debt. So this is all the financial health stuff. Now, is Google a wonderful business? This is where he says it has some advantages. Brand recognition, and we all know Google, obviously. Everyone here in this call, everyone in this club and everyone on this call knows Google. Technology innovation, they invest heavily in technology innovation. They're trying to do these other bets, this division that they call it. They're trying to develop something new, brand new there that would be a crusher for them. Data and analytics, they have large amounts, tons of data, tons of all of our data, unless you're kind of really private. They have all of our data, it's all in there. Scale and network effects, yeah, they're obviously huge and have a bunch of network effects. Culture and talent, they hire a lot of good people. They attract good people to work for them that are solid workers and smart and so forth. So then he goes into, he looks at, this is the past, which I don't think is as much value. And we can skip over this, I guess, and some quotes from Buffett. But then he goes into a discounted earnings model. And this is he expects in this model 17.2% annually for 5 years, 8.6 for 5 years after that, and 2% thereafter, which is pretty aggressive, I feel like. Different than ours for sure. We would go lower. But his discount rate, I'm not sure, his discount rate is 10%. So return available on appropriate market and benchmark like the let me show my stopwatch because I went up past my 8 minutes. But 10%, which is like the S&P 500. So that lowers the return. This the fair value with safety margin. That 10% is high, in my opinion, at least. And so we probably, I don't know how SSGs are calculated and how the upside downside ratio is calculated particularly super well, but this is a conservative discount rate. And margin of safety, I don't even know that. I heard that term before, but I'm not sure how it factors in this calculation. But so I guess, oh, okay, I get it. Yeah, 132.91 is his price per target right now, and then margin of safety discounts that to 1.23.10 cents. So that's what he thinks. It's just a good article to read. I feel like I like it at least, and I'll stop there. There's one more thing. Sorry, one more thing. I want to show. And Henny has asked about what how Google's going to grow. So I asked ChatGPT, how could Alphabet grow its business going forward? This is out-of-date information, so to speak, because it's 2021, but the same thing that applies to 2021 Alphabet applies to 2023 Alphabet. And that's diversification, all this different, driving, self-driving cars, Waymo, cloud computing, compete with Azure and the Amazon one, Amazon Web Services, AI, compete with Microsoft and OpenAI with ChatGPT. So they got to compete, but advertising, of course, for the crush there, and international expansion. So that's all I got. Thank you. I got about probably. You should have about 2 minutes left for me for questions and comments. Yeah.
John, can I show a quick? So I did. Ready? Can I talk? Okay. So John, I have. Can you give me the screen?
Yeah.
I used Hanny's spreadsheet and did a quick assessment on Google. And Hanny,
okay, cool.
And Hanny, hopefully you can help me out. Let's see. Okay, so this is Google 10-year evaluating management. And Hanny, since I have Mac, I don't have the 365, it's not filling this out.
Right.
Okay, so I did the 10-year and then I did the 5-year. Is there would you always go with 10-year, or would you compare 10-year to 5-year to see if there's any improvement or, degrading?
No, the 5-year is just if you don't have 10 years worth of data. But
okay, so
if you do, then just use the 10-year.
Okay, sounds good.
Because I think one of the companies that we tried to analyze only had 5 years.
Oh,
so
yeah.
Then what we did was just increase the weighing factors to make it out of 100, even though it was like 5 years.
Okay. And I'm not sure, this isn't the color coding. This is less than 10, but it's not going green. So, but it did count it correctly. But so Hanny, in your view, is 80 okay? Or are we always aiming for 100?
No, I think 80 is pretty decent.
Oh, because you make it green. You make it green up here if it meets. Okay.
Yes.
Okay.
Yep.
Got it. All right.
Henny, I have a question. This Buckle's spreadsheet is more valid for 10 years data rather than 5 years, right?
No, you can use it for 5, but you have to change, if you want the score to be out of 100, you have to change the weighing factors. So
I think you did that.
I did, yes.
Yes, okay.
So yeah, so you can use it for companies that have a short history. You can just use the 5-year, but they're both. I mean, the 10-year gives you more history, so you're seeing if the pattern is holding, if their ratios are holding. But you can use 5.
This is a fantastic tool, Hanny. I really appreciate what you did. And I added here where you can get the statistics easily. So you can just go to Morningstar Key Statistics here. And then I said where you can get these ratios from. So there's operating efficiency. You can come here. There's financial health for the financial leverage, and cash flow you can get from here.
Yeah, maybe one thing I could, but by the way, just so this is not my spreadsheet. I just took Bakul's ratios and just automated them. But one thing I might try to do in the future, based on what you did, Joanne, is just put hyperlinks to Morningstar, and then you just click on, say, operating efficiency as you have there, and then that would take you to that. But I'm not sure if that would work or not. I'll play around with it.
Yeah, Henny, that's will be very helpful. The source of this data, where to get it from, will be very helpful.
It's all from, you can get it all from Morningstar, or you can I don't know if Jane is on or not, because I think there were some discrepancies between the financial statements and Morningstar. Jane had some comments about that. So
Okay, so
but you can get everything from Morningstar, or you can just go into the financial statements and poke them out.
On that question, the Morningstar reports GAAP data, and we are supposed to use non-GAAP data. Does it make any difference here?
Sorry, my German Shepherd decided to sit in on a meeting, and he's eating stuff, so I had to mute. I think I don't know. The answer is.
Yeah, because typically Morningstar uses always GAAP data,
Yeah.
and BI and fundamental analysis specifically recommends you have to exclude one-time items like tax. Yeah.
Ready, BI uses Morningstar for their data.
They do, but they advise any major one-time deductions, you have to exclude them, use non-GAAP data, which we have to go to other sources.
Okay,
Yes.
well, this is
Right.
another topic. Can we move on to the next annual report? We can parking lot that and have that as you can do an education topic on that, ready?
Come, Kobe.
Yeah, there are a couple of presentations by BI itself.
Okay,
Yeah.
It would be great if we can use Superlink to get the Morningstar data into this spreadsheet, and we can just make some adjustments for the significant events, one-time events that Reddy mentioned.
John, now I know why you skipped it. Skipped my review. I would have learned a lot from this review of this one. But how is really worried about Google and some of these companies going down? I do not know why, but
We should probably move on, but in brief, for me, it's just that when a company that's really strong, the price of their stock goes down, that might be a sign that something is wrong with the company. It's also a sign that you may want to consider buying a company that's great, that's getting cheaper. That's how I try to look at it, but everyone has their own way of looking at it. So
with all the situations going on, Sundar Pichai is doing a great job. Yeah.
okay. Well, anyway, thank you. But I think it's Mina, right? You're next.
Yep, perfect.
Thanks.
Just take on the screen here. Yeah, so LGI Homes, we see that from the Treasury report that it's one of our companies that are kind of most down this year, and I think it's the obvious reason for everyone is the main factor behind this is just the economic conditions and increasing interest rates that have really tampered down the demand for kind of proper real estate, as well as on the other side we have the increase, the bringing a rampant inflation that has resulted in increases on materials and prices. But despite that, LGI Homes continues to rally for this year. So it's just going through the annual report quickly, then we can get to the kind of current comments. We've initially purchased this company at $140.62. Had a closing price last Friday of $105.71. It's just trading for a little bit lower now. I think it's $105.60. Has a 52-week low of 71.73, so quite a bit of variance this year, and the high is 126.6. If you look at the PE value currently, P ratio, pardon me, currently it's at 7.7, which is slightly below its 5-year average of 8.4. So it's good to see that. The 5-year average low P is 5.1, and the average high is 11.7. So it is within kind of its historical performance. Revenue this quarter fell sharply, down 39%. to 488 million this quarter. Again, management and kind of any sort of analyst I see attributes all this to the increases in mortgage rates and interest rates, which have really restricted people's buying power. Overall, for the financial year, it's down 24%. So that really does kind of explain the majority of the decrease in the price. Despite that, the company continues to have pretty good balance sheet. The current ratio has kind of cut significantly. That is not because of a reduction in assets, but more of an increase in liabilities. So their debt, and then what I'm looking into for the debt is a part of it is just the costs have increased, as well as it looks like they've expanded their sales and marketing teams to kind of counteract the reduction in demand and to really connect with the remaining home buyers. And based on the 10K and the call transcript, it looks like they're bragging about generating a lot of record leads for January and February. So far they think that it looks like those investments are paying off, but we'll see with the first quarter reports. But just going, reasons for decline again is just the demand in the Federal Reserve's actions, decreasing prices. What's concerning to me though is that management did acknowledge that they expect those conditions to persist in 2023, and if not, to actually worsen. So, given that they are vulnerable to those external factors, that's why I have, as you saw on the agenda, a hold/sell, because I think if there is going to be there is an acknowledged short-term pain that is going to be felt, there may be an opportunity to sell and buy back in. So that's where the recommendation really stems from, is that both management and analysts predict in the next year or two really a sharp decrease in demand and in sales, but remain optimistic about the 5 and 10 year prospects for the company. So just looking at some of the historical rates, quarterly, again, sales is down 24.4%, which is down 39% for trailing 4 quarters, but over the last 5 years, it's at 14.5%, which is a nice healthy rate we like to see. In the last SSG, we had it as 11% forecast growth. I've reduced it in the current SSG to 5%. The rationale for 5 being the long-term analysts continue to have optimism. Value Line still has, I believe, like 15% for their 2026 to 2028 prediction. And management is pretty optimistic about the long term, but those short-term analysts predict, down 15% sales predictions for the next 2 years. Like, for example, the SSG prediction is that. So I took into account that we're going to see decreases for the next 2 years, but a recovery. So 5% brings us back to roughly a slight increase on where we are on the graphs. So, some progress, but I think it's going to be hampered in the next few years. And I've left the historical growth rate, we've changed it down as well from 17%, sorry, it's 11.8. We've changed that again to, I'm falling closer to 13 to 15% based on what I'm seeing. And again, the management of the company seems to be strong and the fundamentals of the company seem strong. So it really is the headwinds of the market that are really going to reduce those numbers. So I think their ability to continue to earn and reduce their overhead, I think, is going to be strong. The reason we see that the return on pre-tax profit, their pre-tax profit is higher than the 5-year average, so they are becoming more consistent. It's a sign of good management. The return on equity is down to 25.3% from the 5-year average of 31%. So again, I think that's a lot to do with external factors as well. So and the debt to capital ratio is also down. So signs of good management. I think the company is in good hands. One of the other important factors that I've stumbled across is that LGI stands out from its competitors because its ability to offer affordable housing and not, houses in the $500,000+ range. The average sale of a LGI home is like in the $350,000 range. So given some of the prospective pain that we see in the economy, like the tightening of money markets, and even lately with some of the the bank information, the bank issues, there's going to be maybe a demand for some of that lower price housing as opposed to the higher end stuff. Again, yeah, too, with layoffs and in Silicon Valley and all that as well. We think that it looks like that might actually be a factor that will help them keep a competitive edge versus other real estate and home construction companies on the market. And again, to that other point as to why I think the earnings will continue to grow despite the sales being hampered, is that over the last 4 quarters, despite the current economy, LGI has been able to surpass EPS estimates 3 out of the 4 previous quarters. So good signs from there, but again, there is going to be, I think, short-term pain. Turning to the SSG, just so that we can take a look. Like I said, I've reduced the sales forecast to 5%, and I've changed the EPS forecast to 15%. So looking at the lines, I think that is consistent with kind of that upward trend we want to see, where the company, despite some decreases in their momentum on sales, will continue to find efficiencies. Going to the average high price, I used an average high P of 10. It's below the average high P of 11.7, but above the average P of 8.4. I think that's a kind of fair number. If you think that should be adjusted, please, I think we can do that. So that results in a high forecast price of 276. I selected a low price that was 25% of the 52-week low. I appreciate that's conservative, but again, given the variance that we've seen in the price of this company over the last year, and given that these conditions are going to persist for the foreseeable future, I don't think it's unreasonable to think that that low price plus additional pain is possible. So trying to factor that in, I've put it at a forecast low price of $55 a share. Despite that, we still have a recommendation at 3.4 to 1 on the upside down ratio. So that's why I hesitate to actually say this is a sell. We could buy, but again, I think in the next few months the price is primed to lower, and there may be a better opportunity, and so there may be an opportunity to cut some of our losses, sell, and acquire at a better price. But I also have the value line report uploaded on the drive for anybody who'd like to see it as well, or we can go through it as well. But just for the sake of time, if there are any questions, that's really all I have.
I have a comment on that.
Yeah.
These real estate companies building companies are going down. I had a couple of them. I dumped one, and this one I'm sitting at loss. The economy, interest rate, and everything is kind of negative to these companies now, right?
Yeah, for sure. It's definitely a difficult time. The only saving grace for LGI versus competitors is the price point for the properties is lower, so it may keep there may be a higher demand for that price range. But you're right. I think the economy and the interest rates are really going to be the factor that limits their growth for the next while.
Yeah.
There's another risk, and that is a lot of lenders are now starting to look at environmental and climate change factors. So homes that are built in floodplains or where there's a lot of forest fires, if they're susceptible to that, those kinds of risks have not been factored into valuations, and more and more lenders are starting to look at that. So you may have a situation where these homes are actually, the valuations are too high right now given some of these risks, and that they may go down in value. So that I don't know how that impacts LGI specifically, but you know, the selling prices may be impacted if these things are taken into account.
Amy, that's a good comment, but these are new builders, right? Building new houses. Do you think they will not follow any future guidelines on floodplains and other?
Well, if you're building in an area that, you know, is susceptible to floods or forest fires or hurricanes or what have you, then the valuations of the homes will be lowered, right? So they have built using certain price point, but then, you know, if someone is going to give out a mortgage, or they're going to insure a home, the valuation may be different from what the sale price is.
Yeah, the latest projects that I've seen announced are within Hidden Valley Farms, and then I saw in Arizona and in California there were some projects. So to your point of where those areas are specifically, yeah, and Colorado as well. There's been some new projects announced in Colorado. So, you know, if there are forest fire issues, then that you know, to Annie's point, that's a very good point. So yeah, I see Arizona, Colorado, and California right now, just as in sort of new announcements.
Okay, probably should move on to Annie and FCX.
Okay, so sorry, to Henny.
Yes.
Just before Henny takes over, LGIH is in small cap informer list still as of this month.
Hello, is Annie talking or?
Sorry, I was on mute. Apologies.
Okay.
Which screen can you see right now?
Oh, your screensaver. Yeah. Background. We can just see your boat here and your Catarine, your background.
Oh, okay. For some reason it doesn't.
Yeah, now we can see your annual report document.
Okay. All right. I'm trying to close the ribbon. Never mind. So this is Freeport-McMoRan, in case people forgot, is a mining company, mostly gold, and they're very well run company, but susceptible to commodity prices. So we bought this stock in July 20th of 2022, $28. Closing price, I think as of this morning, is up around $36. 52-week high and low between 24.80 and 52 roughly. So we're positive, and that's copper prices had dropped quite a bit in the recent couple of past few months, but they're going back up right now. So, and that's the issue with a lot of the materials and commodity or cyclical type stocks, is that the commodity price fluctuates, and even though you could be running a very good business, you know, you're impacted by the commodity price, which a lot of companies don't have a lot of control over. So the only thing you can do really is just make sure that your operating costs are low and that you're running an efficient business, and Freeport falls into that category. Revenue for the Q4, the company fiscal year ends in December, so their Q4 revenue was down year over year by about 6.6%. And then the annual revenue was down slightly by about 0.3%. Current ratio is good, down a little bit, but not significantly. Free cash flow is down quite a bit, and that's because they were returning cash to shareholders. They had a special dividend in addition to the regular dividend. They bought back shares, and they also reduced their debt. So their free cash flow was reduced as a result of that. Historical sales, you can see here, pretty flat. 5 years, like 10%, but recently it's gone down, and that has to do with the economy, China, COVID policy, and some of the fluctuations that we're seeing in the market. Their EPS growth is pretty strong. Again, last quarter and trailing aside, the 5-year and the 10-year are pretty strong EPS growth. And again, that has to do, I think, with the fact that they're one of the lower cost operators, and so when commodity prices go up, they can really take advantage of that. They did buy some shares, and they're, like I said, they're reducing debt. Management is doing a pretty good job. I think overall that this is a good stock to hang on to. I think that there are a number of macro factors that are working in their favor. So there's a lot of demand for copper in the future because of EVs, not just EVs, but as EV adoption expands, companies are going to have to invest in charging infrastructure, which again uses a lot of copper. You have to put in all sorts of transformers and very intensive wiring and so on. The other thing is the transition to clean energy, green technologies uses a lot of copper, and we're moving very rapidly in that space with solar and wind distributed generation. And then on the other side, on the supply side, because copper prices have been somewhat depressed or not really very stable, a lot of these companies are being conservative and not investing in new projects until they see that there's a sustained sort of level for the price of copper. And once they decide to start a new project for new mines and so on, you have a lot of issues that delay these projects. So environmental, making sure that ESG sustainability for the project and so on, all of that is time consuming and creates some uncertainty. So they're not building new projects as fast. And a number of studies have shown that we're going to have a huge copper deficit in the next 10 years. So the price of copper should go up considerably. So I have this as a hold right now just because of market conditions, but I'll switch over to the SSG. Let me just, I have to figure out how to make this screen my primary screen. So what I've done here is, let me go back. I've put in about a 2% sales growth rate going forward, and I doubled the earnings per share, so about 5%, which leads to about $3.05 in 5 years. Using a 16 PE, which is the average PE here, gives a low price of $24, gives a roughly 1-to-1. So it's based on the SSG, it's a hold. But I think that if we see any weakness at all in the future, I think we should buy more of this company. And then the only other thing I'll show you is from their quarterly report, or their this just shows copper prices and inventories. So you can kind of see the fluctuation in copper price, how it went from 450 roughly high, then down to 325 or so, and now it's going back up again. But these fluctuations are difficult to forecast, and so companies will not commit to new projects until they see demand stabilize and also the price. So you're going to have a supply-demand imbalance as a result. And that's it. Any questions?
Hanny, so I ran this company through that Buckles management, and it didn't come out very well. Is that because, like,
Yeah, and if you who did we have last week? Avi, I think. He said, why would you invest in this kind of company? Because it's not up straight and parallel. So if you're doing an SSG, you're kind of you're looking for a very specific type of company. Typically, these resource companies don't have very good looking SSGs, but I think, you know, the mechanics of doing an SSG aside, you have to look at the driving force for any company and what's the supply demand picture look like. And so if we agree that, you know, copper is going to be in high demand in the future because of electrification, infrastructure renewal, and so on and so forth, then the price of copper is going to go up. And this is one of the largest copper producers. I had a slide which I don't have handy right now, but if you compare Freeport to some of the competitors like Vale, Rio Tinto, Southern Copper, the stock has outperformed over the last 5 to 10 years, say by a significant amount. So they're operationally doing better than their competitors. But yes, if you run it through some of the metrics, you won't get very steady because of the fluctuations in copper prices. And that's why these companies you really have to look at the big picture and kind of make sure that they're running an efficient business and they're a low cost producer. And if it's those two things, then when prices go up, and the same for oil and gas companies and energy companies, we saw in the last 5 to 10 years, energy was doing very poorly. Last year it did very, very well and continues to do so.
okay, thank you.
Okay, if there are no other questions, I'll switch over to my catamaran.
Pull it up, B. Turn.
Thank you, Henny.
Vertex, I
was
think,
great.
will be the next presentation.
Vertex?
Yeah, Jane, I'll hand you the screen.
Yes. I'm waiting.
You should have the request now.
Okay. Can you see my screen?
No, not yet.
Okay. For some reason, it's not coming out. Privacy and security. Do I have to set?
You have a
Sorry
Mac?
about that.
Jane,
Oh
do
yeah,
you-
I have. I'm setting the privacy and security. Why is not coming? Oh, okay. Let's see. Yeah, I have a Mac.
Okay. Is it prompting you to change something, or do you have to do it
Yeah.
yourself?
I have
Okay.
to do it myself. Privacy and security, I have to.
Yeah,
Jane,
security and privacy.
Jane,
Screen recording. Yeah. Yes, go ahead.
we can bring up your documents for you, and you can just speak to it. Do you want us to bring it up? Is it in the
Okay.
drive? Okay.
Yeah, it is in my drive.
Okay. Hold on a second.
Sorry about that. I
No
don't
worries.
know why.
VRTX. And it's annual,
Yeah, annual.
22 Q4 and full year.
Correct.
Okay. And which do you want open?
Firstly, you open the annual report summary, and you open the SSG PDF file.
Okay.
I have the BetterInvesting here, so never mind. Just the annual report summary.
Can somebody give me the screen?
Yeah, and also the value line report if you can.
Okay. Hold on a second. Where is the value line?
It's in the analyst report.
Okay, analyst
Yeah.
report. Okay, got it. Doke.
Okay, great. Okay, sorry about the hiccup. And can you make the screen bigger?
Yep. Is that okay?
Yeah, it's okay with me, but it's okay with everybody. Okay. Can you scroll it up a little bit? So Vertex, we first purchased Vertex back in 2021, January, and we increased position 3 times. And we have a total cost of about 8,500 and with about 40 shares. So the average cost for Vertex per share is 215. And as of last Friday, the share price closed at 295, and the low price for the year is 233, and the high price, I think Vertex have hit 325 this year. So as you can see, current PE ratio is 23, almost 23, which is quite all right compared to the average PE for the 5 years. And so it's not extremely low because the share price has been holding up quite well. And the financial performance for this year, the revenue has reached 2 billion, 2.3 billion, 2303, compared to last year, last year, Q4, the revenue has increased 11%. For the full year, the revenue has increased 18% to about $9 billion. And the liquidity, if you look at current ratio down there, current year 2022, current ratio is 4.83 compared to 4.46 last year. So the liquidity has improved as well. And as you can see, the free cash flow this year has increased significantly from last year. That's because last year they had 900 million payment to CRISPR Therapeutics company under a R&D project that they collaborated with last year. So they have to pay out 9. So if you add back the 900 million, the free cash flow also did increase, but not as significant as you can see here. Down there, you can see the stock selection guide. Now I will just show you the SSG. Can you pull out the SHG PDF file? Yeah, great. So if we can look at SHG for VRTX this year, if we can make it bigger, would be great. So based on the this year's performance, I have picked down there. I have picked. Can you go scroll to the first page? Yeah, I have select the first page. The first page, yes. Yeah, I have selected the sales growth rate of 12%. That's comparable to the current, the past 2022 performance, and also is comparable to what value line suggested. And I also look at the previous performance, not only last past year, but this 5 years for this company. So I selected 12%, and I use the preferred procedure, which I cannot show you, I'm sorry, but I use the preferred procedure to come up with 11.8 earning per share growth rate. So based on these two ratios, I have calculated the 5-year high price based on down there, based on the average high PE of 22.5, which is I take 25.3 for 2022, this figure, and I discount it by 10%. So that comes with 22.5. I arrive at about $500 for the high price. And for the low price, I use the low PE of 15. That is based on last year, 2022, the low PE of 16.7. I again take about 10% discount to come up with 15. So the low price is 192, and the current price, not current price, last Friday's price is 295. Yeah. So based on this, that the upside and downside ratio is about 2 to 1. And I would think my estimation is quite conservative. So even though it's the whole, but I have looked at other analysts' recommendation. Some of them, most of them are taking a buy position. But I think for now, since we already added this stock for 3 times, we purchased for the first time, we added twice. So I think it has about 20% in our portfolio. So I think it's all right. And I think we should watch out for this price, this share price, and possibly take some profit off the table when this share reach about $330 or higher. And if we go back to the annual report, thank you, Joanne, the annual report. Yeah. So the annual report, as you can see, not only the financial performance is doing, is showing quite well, but even the operationalized, we always have to look at the drivers of the profit making of the company, and also we look at the operation efficiency. And as you can see, the revenue keep increasing because if you remember the major medicine that this company has been inventing, has been improving, is this Trikafta. This is a drug to treat cystic fibrosis, and that's a very serious lung disease. And the population of this disease, lung disease, is quite wide, and it ranges, from young kid, since birth, all the way to adults. So they have been promoting this medicine to different age group. So they started with age 12 and up, and now they are going down to, 6, and also going down to 2.5. And they are not only selling the the medicine in US, but they are selling all over the world, especially Europe. They are doing quite well. And this is a rare medicine. So when Rady and I proposed to purchase this share back in 2021, and even though we know this is a rare disease, but we know the demand for this disease is quite high, and it surely proved that it's the right judgment. And so they keep on, expanding their labels, and they keep on. Not only this, the good thing about this company is that not only this medicine that they are promoting and they are selling well, they have a huge pipeline for different drugs. As you can see, under point 3, they incur significant R&D expenses, and their results are showing. And a lot of these new drugs like kidney disease, and they also, as you see earlier, they also collaborate with some other biotech companies, and they are seeing some result. And they also work on type 1 diabetes, and all these are showing result, and some of them are already in stage 2 or 3. So I see this company has great potential, even though the share price is not cheap now, and we are not recommending to buy. But I think this is a good company, and Goldman Sachs 12-month target price is 440, and that's a little bit high compared to value line. Can you pull a value line, Joanne? Yes, as you can see, value line, it can be bigger. Yeah, the value line, the 18-month share price is 360 about. So even though even though it's lower than 440, but I still see there's upside of 20%, even more. So I highly recommend we keep on holding this stock, but think of divesting it when the price hit about 350, 340. Yeah. Can you go back to the annual report? Yeah. So the revenue guidance for next year, 2023, is also increased significantly. Sorry about that. And also increased significantly, and that has increased up till like 9.7 billion, and that's in line with the value line projection. And go down. Yeah. So there are 2 phase 2 studies, and you can see, as I mentioned earlier, and there will be still a lot of things in the pipeline. So I highly recommend that we hold this share and consider to divest a portion of that to take some profit, and then probably in the future buy it back on weakness if we have that opportunity. Yeah.
Hey, can I show?
Yeah.
I did a Bakul's evaluation on Vertex. Can I show that?
Yeah, please do.
Okay. Let's see if I can find it. Hold on a second. So this is my question for Hanny. if it's 10 years, it's 69, but if it's 5 years, they're almost 100. Is Hanny
Yep.
there?
Yes,
Is he
I'm here.
So that's a big difference. It kind of goes from not meeting criteria to like exceeding it in the last 5 years.
Well, the fundamentals of the company could have, when they were first starting out, maybe they didn't have very good margins or what have you, or and then as their drug pipeline started to grow, the numbers improved. So this just shows you like the general pattern of these metrics like return on equity and so on. So what this is saying is initially they weren't the business wasn't firing on all cylinders, but then in the last 5 or 6 years, they managed to do much better. So.
Okay.
I think this is a biotech company. It takes time for the pipeline to grow. So, and also it takes time to market the medicine once it pass the FDA test. So I think we should look at the last 5 years. That means more to us.
Yeah.
Yeah.
Just one thing, Joanne, like it's, I think because you have a Mac, maybe because I have conditional formatting in these cells, and that maybe.
But this should be green.
Yeah. So I'm not sure. It works on mine, but I think it's. I can look at that. I have a Mac as well, and I can maybe play around with it.
And you know what? I've been copying these things, and I mean, yeah. So I don't know if I stripped it out or, yeah. I don't know.
And I really look forward to having the super link painting. That would be wonderful if we can have that in the spreadsheet.
Yeah, I will try that. I'll see if I can get it to work.
Yeah,
That would be great.
It's a good kind of quick reflection of how well the company's managed, I think.
Yeah,
but
definitely.
It really depends on the type of industry, because we tried to do it on a REIT and I tried to do it on a bank and it didn't work.
Oh, I see. Yeah.
Yeah. So it depends on the type of company. Okay, should we go on to
Yeah.
Ready? Ready, I'm gonna give you the screen. Let's see. Okay. Are you ready?
Okay. Hi, John. I'm muted. I was muted. I could not do anything, but I think IIPR is in a special business. It has unique drugs on cystic fibrosis, if I remember. So that's a unique product. And you cannot judge 10 years based analysis with a 5 years data. Okay. And these are all, that one and including IIPR are different trend for 5 years compared to traditional 10 years analysis.
Okay, ready? I gave you the screen. You have to accept. There you go.
Okay. I'm glad I have gotten this reviewed by Joanne yesterday, and that's I think everything is okay here. This is in IIPR. This is a specialized REIT company. We updated the analysis as of yesterday. The company, the last quarter, I wanted to present because there were a lot of negative news, and some of them are intentional by hedge fund people, but I didn't get the chance. But here now, when I got a chance to present, there is not much negative news, and things are going okay. They are stabilized, but things are kind of down because of the last quarter effect. Okay, yes, we bought the price at 99.9, but current price is as of a weekend $80, and if the variation between for 52 weeks is high because of all the negative news that were pouring in through last quarter. PE ratios are still good. The company is becoming a more stabilized, established company, and this is only 6 years since they changed from some other mode to REIT company, REIT. Okay, so 5 years average PE and 5 years low and high are still in the reasonable range. We looked at the earnings and yearly earnings, quarterly earnings. This is based on AFFO required for, thanks to Henny, he showed us the procedure how to analyze REIT company a while ago. We had to follow AFFO, not EPS reported by Morningstar, not FFO. AFFO is the one we used it. The revenue is straightforward, and revenue growth is still positive and good. The current assets, current ratio is still good. Free cash flow, the sales are still going up, very good. There's no problem with the sales. There's no problem with the revenue. Earnings are still up. The profit, pre-tax profit is up, trend is up, return on equity is up, and debt to capital is very low for this company for a long time, and it's still down. The historical dividend by this company, 7 years since it's registered as a REIT, it's steadily growing, and it's one of the best dividend company, over 8%, and close to 8.5%. That's the one of the highest dividend paying company. Shares outstanding did not change. Average payout as of the 2022 quarter is 7.1. I will show you a next clip after this one. They already declared dividend for the 2023 quarter one already, and that's higher than this. Compared to last quarter, this quarter I can show you. This is a good time to show. Okay, this is the analyst's latest analyst recommendation by, I think, Yahoo Analysis. You can see most of them are hold, neutral, or buy, overweight. Sell in this list is 0. Only the analyst that reports sell recommendation is Schwab. And you can see either maintain or upgrade and downgrade to market perform, not sell. So the yearly recommendation, the dividend is 7.1, increased 24% year over year, and 2023 quarterly dividend just declared is $1.80. That's quarterly dividend, and 16% higher than 12 months ago. Yes, there is some issue. This is a well-established company now. By now, because of that one, there are a couple of tenants in default, and their rent collection is still about 91 or 92%. I just put a rounded off number, 90%. The one tenant is giving problem because they are not doing good, and that's some hedge fund guy was floating negative news last quarter, but there is no negative news this quarter. and my recommendation is to hold, because the price has come down quite a bit, and the chances are, okay, this is the latest news on, just published 3 days ago. They declared a new quarterly dividend. This is the only company, this is one of the few companies where quarterly dividend is completely going up steadily, and the revenue is going up, AFFO is going up. And the file that I submitted has conservative number 25, but I changed to even 20 high PE ratio, and still shows it's a buy with the 8.9, almost 8.9 to 1 ratio. All it is happening is this is becoming a well-established company, stabilized company, but this is a different REIT than regular rental apartments or shopping complex rental. These are different. What else I want to show you? Yeah, this is also covered in the BI website. This is small cap investor newsletter that BI publishes. It's a subscription, and I do, and you can see that IIPR is still in the list as of this month. Okay. Any questions? I'll be glad to answer.
Reddy, these guys sort of loan their clients money, is that correct? Because a lot of these cannabis companies can't get financing, so IIPR loans them money and then sort of makes it part of the rent.
No, close to that, but IIPR buys the properties even from the guy who is running the cannabis business. They buy the property, they buy the real estate, and
Yes.
then rent it back to the operator.
Right, but in addition to that, some of these companies, because of certain states or federal law, I think in the U.S. that I'm not that familiar with, but correct me if I'm wrong, they can't access bank loans.
Yes.
And so IIPR will kind of loan them money for leasehold improvements or other things, equipment and so on, and then they will collect extra rent to compensate for these loans. Is that right?
I don't think they loan the companies. They either outright own the properties and ask the tenant. The tenants are just tenants to write the leases such that tenants spend their money for development, but the IIPR does not loan the money. They get their money from the shareholders and investors.
Yeah, but okay, you might want to just check on that, because I think I used to review this company for Bernard, and I thought that was something that they were doing. So, and that kind of increases their risk because of just the current market conditions and interest rates. But in addition, if some of these tenants go under, not only do they lose the rent for the property, but any sort of leasehold improvement or money that they lent them to buy equipment and so on is also at risk. So might want to just take a look at that.
So Henry, are you saying that they loan money directly, or was it in the form of just kind of making the advances on the leasehold improvements and forwarding the, covering those payments as part of, as opposed to most commercial leases where the tenant is responsible for all of those things? Is it just that their leases are their leases are structured in such a way that they will cover those costs and kind of just upcharge?
I think
Yes.
they may give development rights to development activities to tenants, but they own the property outright.
No, there's no question that they own the property outright. I'm not questioning that at all. But
Yeah,
in addition to that, like say a cannabis company wants to buy special lights to grow the plants, and they can't access financing. So what IIPR will do is they will lend them the money, or they will do they'll purchase the equipment on their behalf and then include that in the rent payments. So if the client goes bankrupt, IIPR is out not just the property or the potential rent that they were getting, but also some of these advances that they made for equipment and so on.
I don't think IIPR loans the money. They depending on the negotiation, they may do the development, or they give the development activity to the tenant. But okay, we have to go through 80 pages report.
Okay,
More
ready.
detail.
We need to table this. Maybe you can do some offline, look into this offline, and because we only have like 15 more minutes to go. So I think we want to do guests, right, Mina?
Yep, so I think that's all for the reports at this point. We can turn to our guests. So thank you for your patience, guys. Brian, thank you for joining. I think you are self-muted, but welcome to our meeting. And did you have any thoughts, questions, feedback?
Okay, yeah, good, excellent discussion. When John gave his talk, he deleted some of the years up until the last two, and I think that was to get that the sales for the last year was 9.8%. And I was just going to mention that if he goes down to the earnings per share forecast box and clicks on that, the preferred procedure will come up, and down on the bottom of the selections, there's the earnings per share growth and the sales growth for the last years. And then if you start from, it starts and then it goes back 1 year at a time to the 10, and then the first number would be the 9.8 that he was looking for, if that's what he was doing.
Yeah, that was it. So thanks, appreciate it.
Okay, that's the easy way. And then for the management score, for the values that you were putting out there, it said 81. I was wondering, is there a kind of a scale? Is 90 and above good, or is 85 and above good? I understand the rest of it in the green and the scales. I just wondered if there was an associated score values for that, green, yellow, red, or anything like that, or just to show that maybe if you're comparing two companies, if one of them had a score of 81 and one had a score of 91, the 91 would be better. Just a question to think about. Oh, and then the last one for the REIT. I'm guessing that because you're a club that uses virtual money and doesn't have to actually file and worry about taxes is why you have a REIT. That's the only comment on that. Otherwise, it's an excellent meeting. Thank you very much.
Thank you, Brian. That was really helpful, and appreciate you joining us. Evelyn, welcome. Thank you for joining our meeting. I believe you're also self-muted, but please feel free to unmute and let us know if you have any feedback or any questions or concerns. Nice. Okay, well, if not, thank you very much for joining us. And you're always,
There's
Brian
Susan.
and Susan, feel free to continue joining our meetings. The link is will just need to be updated, but again, every third Monday of the month. So yeah, thank you very much for joining us. So I guess we'll turn now to any club business. Are there any motions to?
Susan, did you mention Susan, Mina? Sorry if you did.
I did, yes, and I think Susan is self-muted, and I think she's listed as not attentive, but
Sorry, my bad.
no, not at all. But yeah, so Susan, feel free to unmute at any time and let us know if you have any feedback. So again, welcome. Yeah, so just turning to any club business in the meantime, are there any motions to buy or sell any of the securities that we discussed today?
Club business. I don't have any motion to buy. I mean, I could make a motion for Amazon for Google, I guess, Alphabet, I guess. But really, I feel I'm concerned that we don't have a stock for Anitra to cover right now. I'm concerned that we should probably try to find a stock that maybe. I know we have to do a stock study, and we did one last month, and it didn't seem like either one we wanted to buy. So we're in a kind of a rock and a hard place right now in that regard. But I just want to bring that up, I guess.
I can work with Anitra and on Schwab because it's kind of a unique stock. It's like a bank, so it uses different, variables. The SSG looks different from a standard SSG. If Anitra's interested in learning about banking stocks, actually Schwab's doing okay since all the small banks are like imploding right now. So everybody's trying to move to more stable banking, I guess. So
I had a different idea as well. I had another idea it's kind of tagging Anitra all over the place because she did that thing with Annie, and then she did a stock study with us, and now she's going to do potentially Schwab, and she could also potentially do Disney if Hoyle is going to be gone for April.
Oh, that's true. Yeah.
Why doesn't you do Disney? You guys want me to do Disney because I'm in Florida? You're going to punish me, aren't you?
Oh, yeah, you're in Florida. I can help you.
Yeah, enough I have to deal with the governor. You want me to get Disney? Okay. As far as Schwab is concerned, one second. Let me take my cough drop out. As far as Schwab is concerned, doesn't sound easy, and what I've seen on banks, it doesn't look easy, but everything is something I could learn on, so that sounds okay. As far as Disney, it's not bad either. I did invest in Disney at one point. I think I took it out because it was so much going on, but either one of those things is fine. But so whatever you guys decide, but I would need help with banking for sure.
Let's put you on Disney while Hoyle's out. He's out for a couple months, so yeah. Is she have an annual or quarterly report due? And do you know? Oh, John, you're muted.
Yeah, it's just quarterly. Okay. But so if you want to, you don't really have to present it, but if you want to, you can. Yeah, sure. Yeah. I mean, if you want to buy or sell, you have to present. If you want to just hold, you recommend to hold rather. You wouldn't have to present it if you didn't want to, but yeah.
Okay, I do have a question for the group. I really enjoyed listening to everything, but my question is, some of the companies sounded really good. You guys love the company, and yet it's not quite a buy. Is there a way that you ever considered putting in a purchase if it falls to a certain price or anything like that?
Yeah, definitely. If we can make motions, and it's difficult to track just in terms of making sure that we're following through on the motion. But I know we've done in the past where we've set a motion where kind of a buy price or a target price for a certain company.
What's that called? I forget, because I think I've done that before. You put it in
limit
order.
Yeah, limit order. We can, yeah.
But aren't they only good for like 30 days? Is that?
Yeah, you set the time.
Yeah.
Oh, you set the time? What's the longest time you can set?
Good till canceled.
That will be around 90 days.
Good till canceled is in the US is I think 180 in Canada.
Oh, 180 days. Okay.
is it 180 or yeah, I think it's 180, and in Canada it's 90 days. I can't remember, but I think that's right.
So until canceled is 180 or 90?
No, in Canada it's 90 days.
Uh-huh.
In the US, it's 180 days.
Okay. I guess we could try it.
Well, there's a better way.
What?
Well, if you want to buy it at a certain price, and then you know that what that price is, you would sell a put and get paid for it. And then if it doesn't reach that price, then you sell another put. So say you sold it expiring in 30 days, and it didn't reach the price on the put, the strike price, then you still get paid, and then you do it again. You just keep doing that. The downside to that, there's two risks. One is, say you know the stock takes off, and you put a, so say it's at $100 and you want to buy it at 90, so you sell a put at 90, and then the stock takes off and it's at 120. So even though you got paid, you kind of missed the opportunity to participate in the upside. That's one. The other downside is if you sell a put at 90, the stock's at 100, and it falls to 0, like First Republic or Signature Bank, then you're stuck. So which is something that just happened to me actually. So I got stuck with, I sold some puts on, I think it was Signature Bank, and I got assigned, and the stock basically went to 0. So, but that was, I knew that was a risk, and that's, you know, so it's not a huge amount, but
Hopefully your Las Vegas money.
Yeah, exactly.
Okay, all right. Well, since we don't really put any money in, it's all manual, I mean, tracking, so yeah, I don't know.
But you know, the other side of that, just sorry, is if I had purchased Signature Bank stock, I would have still been in the same situation, right? So
yeah.
that's kind of a black swan event that doesn't happen very often.
How did you pick that? How did you pick that?
I can't remember. I honestly can't remember. I do a lot of these, so I just I need to keep a book or something.
Yeah. And the reason why.
Well, we're going to have a lot of cash pretty soon. We already have technically a lot of cash. I would not technically, but in my opinion, a lot of cash already. Our 10% of our assets are cash. So we're going to not buy something next month, most likely, because we're doing lots of annual reports and maybe a quarterly report.
Unless there's a buy, unless one of them.
Oh, yes, there's a buy. You're correct. My bad. That's correct. You're right. If there's a buy, we'll spend the cash. Okay, but just saying, you know, before we get into
there's I think you know, I don't think there's anything wrong with holding cash during this period, right? Because things are moving a lot, and I think there's still opportunity for the market to go down further. So
true.
It's a prudent thing.
Yep.
Okay. I'm on board with that. Keeping cash.
Yeah, cash is king.
You can put a link order with your own date also on some websites.
Oh yeah, to get flagged, yeah. Okay, guys, it's what, 4 more minutes. Is there anything else? Oh, Reddy, were we going to talk about how do we reinvest and how do we deal with dividends? Does anybody know with this, you know, virtual club?
You can just rebuys that same stock at the current price when the dividend is issued, right? Danny might know. He was treasurer at one point, right?
Yeah, I think there's a I'm trying to remember. I think there is a feature in iClub to reinvest the dividend, if I'm not mistaken.
So did we not?
Otherwise,
Go ahead.
sorry. Otherwise, you have to do it manually, and it's a bit of a pain.
Yeah.
Do you have to reinvest, or can you put it in cash? Take it in cash.
I'm not sure. I can look into it. I'm not sure.
Okay.
You can, I don't know if iClub allows you to do that, if it has that feature.
Okay.
But on any brokerage account, you can either put it in cash or you can reinvest the dividends. And you have to make that decision when you open up your account, or you can change it. So I can find out and let you know.
Okay, thanks, Annie.
Annie, yeah, me and Joanne were discussing that question. If you own the actual stocks, some companies do allow that automatically, but in our situation where we have a kind of fictitious investment, how do we handle that? And
well, the easiest thing to do is just reinvest the dividends. So the number of shares increases over time.
yeah, but we have to do that manually, right? Because we don't really actually own the share.
Right. That's what I'm going to check into. So I think iClub has a feature that because they're quite sophisticated actually in iClub. You're doing a lot of clubs hold real money, so they have tax. There's tax implications. So I think there's automatic dividend. I'll find out. I'll call them and find out.
Thank you, Hanny.
Yeah, thank you, Hanny.
Okay. Anything else?
Yeah, I hear Brian say something about meeting link. I missed what he's saying. Something, Mina said we will update the link.
Oh, the link for future meetings if they wanted to attend.
What happened? They did not get it?
No, I'm just saying that they'll just need a new link, but they're free to attend and welcome to attend the future meetings.
What do you mean they need a new link?
A link to the meeting?
I can answer. Can I say every month the link changes. Some groups, the link is the same all year long, but like today I clicked on the first link I saw, which was February, and then I clicked on the next link, which was March. It worked. And then I scrolled up and down. So each month for this club, the link changes for that month, which I think it's good. It makes sure that people are current and they want to show up. So,
No, the meeting link does not change. The same
it's not?
meeting. It's not. It's all the same.
No, we've had people that issue come up for people before where they've tried to attend kind of a second meeting. They didn't receive an updated meeting link, so we've been sending them a new link for.
Jay, look into that. Let's test it, okay?
Yeah,
So
because
wait, hold
it's
on,
happened in the
pause.
past.
We only change going forward from next month. Yes, we will have a new meeting link. Because I
Right.
just sent an email. I deleted. They just need to register once. They will receive reoccurring meetings. But going before that, the meeting it had changed a long time ago. But it should be the same link.
It's okay. Going forward, it should be fixed.
Yeah, going forward, fix. However, we do need to let people know that's the new meeting link.
That's
I
all
have
we're saying. Yep.
in
You
my
don't need to sign
calendar.
up. Anitra, you don't need to sign up.
No, I don't need to sign up. No.
Uh-huh.
What happens is once I register, or I don't know how I got it, and it downloaded, I have it through July 17th of this year, and the numbers are different. If you look in it, the numbers are different on the inside. The end numbers look the same, so you can't look at that. It's like right after it says .com, pjoin, / and then that's where the numbers change. But once they're sent the link, if they actually add it to their calendar, it's going to update. They just have to go in and scroll down under where it says URL, scroll down to that particular month. But, you know, that could,
I did not understand. You mean July 2023?
yeah, I have February, March, April, May, June, July 2023. That's as far as it goes.
No, they already deleted up to. That's okay. We make sure that we advertise for the April correctly.
That's all we're saying, yep, so that they
yeah.
have to use
Okay.
that link, that's all. That they use the April link and not the March link. Yep.
Okay. Okay.
Okay, all right. We should
Good
adjourn.
night.
Let's take this offline. Let's take this offline, Jay, and adjourn the meeting.
Okay.
Oh,
Yeah,
great.
and also, Joanne, can you help me to set my privacy so I can share the
Yes.
screen?
I can, okay, so let's adjourn the meeting and I'm gonna help Jane. Okay.
Yeah.
Thanks, everyone. I'm going to stop the recording now. Thank you.
Thanks. Yeah, stop the recording.